Advanced Cash Flow Modeling for Effective ALM in Banks. Asset and Liability Management, ALM, is a critical function in banks, involving the management of assets and liabilities to maximize profits while minimizing risks, such as interest rate risk and liquidity risk. The foundation of effective ALM lies in accurately forecasting cash flows from both assets and liabilities under various scenarios. Understanding cash flow modeling. Cash flow modeling in the context of ALM involves projecting future cash inflows and outflows from assets and liabilities. This modeling plays a pivotal role in understanding the impact of various financial and economic changes on a bank's balance sheet and overall financial health. Key components. Interest rate scenarios. Modeling involves various interest rate scenarios to assess the impact on cash flows. Behavioral assumptions. It requires assumptions about customer behavior such as prepayments for loans or withdrawal of deposits. Risk parameters. Incorporation of risk parameters like default rates and changes in market liquidity. Advanced cash flow modeling techniques. Let's delve into some advanced techniques that can enhance ALM strategies. Stochastic modeling. Stochastic modeling uses random variables to simulate various future states. It's particularly useful for capturing the randomness of interest rates and their impact on cash flows, allowing banks to evaluate their risk under different economic conditions. Monte Carlo Simulations. A step beyond stochastic modeling, Monte Carlo simulations use a computerized mathematical technique to predict the probability of different outcomes. For ALM, this means generating thousands of potential future market conditions to assess how well a bank's cash flows, and, consequently, its liquidity positions hold up under each scenario. Machine learning algorithms. Machine learning algorithms can analyze vast amounts of historical data to predict cash flow patterns and detect nonlinear relationships that traditional models might miss. This includes predicting customer deposit behaviors or loan prepayments under varying economic conditions. Implementing advanced modeling in ALM strategies. Scenario analysis. Implementing advanced modeling begins with comprehensive scenario analysis. Banks should create both realistic and worst-case scenarios, like economic downturns or rapid interest rate hikes, to understand potential impacts on liquidity and market risks. Stress testing. Stress testing involves applying these models to extreme conditions to ensure the bank can withstand unusual market events. This helps in identifying potential vulnerabilities in the balance sheet and assessing capital adequacy. Strategic decision-making. The insights gained from advanced cash flow modeling should guide strategic decisions, such as altering asset composition, adjusting interest rate exposure, or modifying funding strategies to enhance yield and manage risks more effectively. Challenges and best practices. Data quality and management. Successful implementation requires high-quality data. Banks must invest in robust data management systems to capture, clean, and analyze data effectively. Model validation. Regular validation of models against actual outcomes is crucial. This helps in refining assumptions and improving model accuracy over time. Regulatory compliance. Lastly, banks must ensure that their ALM practices and models comply with local and international regulatory requirements, including stress testing regulations and capital adequacy norms. Conclusion. In the rapidly evolving financial landscape, advanced cash flow modeling is not just an option, it's a necessity for effective ALM in banks. As we move forward, the adoption and sophistication of these models will undoubtedly increase, playing a pivotal role in the future of banking and financial stability. Want to learn more? Claire Trithel on LinkedIn.